We've got an excellent panel here today. There is no one who's a serious investor who's not interested in income. I know I am. And of course, this is a world that's starved of return, particularly from an income point of view. So we're really lucky today to have two of the top commentators on income and other matters financial with us. I'm not going to be doing very much talking because they are perfectly capable of telling their own story, so I'll just be setting the scene for them. But the first person is Charlotte Ransom, who's going to come on stage as the CEO and founder of Netwealth. We're really lucky to have her here today and Netwealth, which is a complement to Fidelity, the very established behemoth of the industry, stable, been going a long time with a very wide range of funds. And then you have Charlotte, the disruptor in the fund management industry, very complementary and both highly recommendable to investors. I'm going to ask Charlotte, the co-founder and the CEO of Netwealth, to come up. Please give her a big hand. Charlotte. In this audience, by the way, I want to point out that I have my stepmother, Philippa, my father, Jimmy, both of whom have turned 90 this year, and both of whom are still very interested in investment, and particularly in income. And also, the provost of the old college, very old college that I went to many years ago, is with us today as well. Neil Mendoza, who's in the front row as well. So we've got a very distinguished audience overall, and we've got these three particular eminence gris with us as well. But we also have John Stepek. Many of you will be familiar with him. He is the editor of MoneyWeek, which is the most widely read and sold financial magazine in the UK. John is a very old friend of mine, a dear friend. And John has asked me, that's not true, I'm doing it without him knowing about it, to promote his new book, which is called The Skeptical Investor. What a great title. It's just come out, and he's kindly given me a copy, and he's going to sign it later on. But John is very well known to many of you here, and so I welcome him on the stage as well.
Thank you, Jim.
So, John. Now, I'm going to set the scene very briefly. We all know how important income is. If you look at this chart of the FTSE in the last 10 years, you'll see that had you not reinvested the income, or had there been no income from FTSE 100 companies, your return would have been around 60%. With income, it went to about 95%. So income is extremely important to investors. However, income does come with its downsides. At the moment, as you know, many income instruments, particularly bonds from the governments of the Eurozone, are negative yielding. So the fools who buy those bonds are going to end up with less than they put into them if they hold them to maturity. It's very hard to find income, and it's hard to find companies that have got sustainable levels of income to produce sustainable dividends. And that's why these two experts are going to be talking about how we find that income in our portfolios. It's interesting that the S&P pays out only 46% of its earnings as dividends. Part of that is due to the fact that there are tech-heavy companies that don't pay dividends in the S&P. But in the UK, the FTSE 100 pays out 74% of its earnings. And that's considered to be an unsustainable level by most investment experts. So as we look at income from an investment point of view, we have to be very careful about companies that are sacrificing future growth to maintain unnecessarily high dividends. It's a big red flag for investors to watch. And do not be lured in by unsustainably high dividend yields. Now with that, I'm going to hand over to Charlotte, who's going to talk about how her company, Netwealth, deals on behalf of investors with the big vexing problem as how do we generate income in this shortage of income world. So over to you, Charlotte.
Jim, thank you very much. And what I'd like to do actually is start with the polling question, which I hope you will have all seen. Oops, let's just go back for a moment. You've got the polling question in front of you. To ask you all how long you think you might live, which is perhaps a slightly strange and personal question to be asking, but if we're talking about income, we need to think about how long we are generating income for. And I think we're getting some live results now. And that's actually quite interesting because around half of you think that you'll be somewhere between 80 to 95, with 20% reckoning you're only going to get to 80, and then an optimistic 30% thinking that you're going to get to 96 plus. Well, actually, it's quite interesting. On average now, if you're a man between 45 to 65, on average, you probably will get to your mid-80s. If you're a woman, you maybe get to late 80s. But 25% of us between 45 to 65, as a man, will get to mid-90s, and as a woman, late 90s. And then for men aged between 45 to 65, around 10% will make it to 100. And for women, that goes up to about 15%. So when we think about income, we need to be thinking quite hard about how long that income needs to last. Now, what I'm going to do is start with what at Netwealth we call the three-pot theory, because I think this is a sort of rounded way to think about our overall wealth, what we're doing with it, and what we need it to do for us. And I start with pot one. So pot one is the liquid pot. You've got income coming in maybe from dividends, you've got maybe rental income, you've got salary perhaps coming in, and of course out of there you've got all your normal outgoings. So that's your kind of, your liquid pot, your current account if you like, doing its thing. At the other end of the liquidity spectrum is the illiquid pot, pot three. Now this typically starts with our home. Maybe you've got into the buy-to-let market, so you may have houses. It's going to be investment trusts. It's going to be managers that you particularly favor or stocks that you particularly favor. And it's going to be probably things that are either less liquid and more costly to buy and sell, like property, or it's going to be things that are more risky and more volatile, like, for example, single stocks. And I sometimes call this the passion pot. And actually, Jim and John, between them, I put them in my passion pot. So they're coming up with super smart, cool ideas. And you know, the truth is, for most of us as investors, the passion pot is where we like to be. That's where we like to spend our time. Now, I'm going to come back to pot two, because that is where, for many of us, we don't particularly like to spend time. But as we think about generating long-term returns, it's important to have pot two. What we think of as pot two is globally diversified, multi-asset portfolios that are going to be managed over a medium to long-term horizon, and that are designed to create what we call sleep-well returns. And typically, we are only thinking about fixed income and equities, and therefore, we're able to make sure that pot two is transparent, flexible, and liquid. And by achieving that, it means you start to create better efficiency across the three pots. I meet people often who have much too much in pot one because they're trying to support those outgoings that we talked about, and they can't do it out of a pot three. If you create a properly efficient and liquid pot two to complement those other two pots, that's the way to create the best all-round investing environment. Now, I'm going to come back to pot two in a bit, but I'm going to hand over to John, who has some ideas for pot three.
Yes, I think Jim, when he introduced me, pointed out that I've just published a book called The Skeptic Investor. Obviously, you know, I'd like you all to buy it, but I'm not going to twist anyone's arm. But it's broadly about contrarian investing. And I think that that's probably guided where I'm looking for income investments today. Now, you may have noticed there's a wee bit of political turmoil in our country at the moment. I mean, you know, I'm not sure if it might have gone over some of your heads, but, you know, at the moment there's a lot of kind of disaster in the headlines. That is entirely understandable. The papers all need to write about something. But it also does present us with the opportunity to take advantage of this panic. Regardless of how you feel about Brexit, leave or remain, it's up to you. Regardless of how you may feel about the prospect of a Jeremy Corbyn government, it's not something that I'd particularly welcome, but again, up to you. What you have to consider, I think, is valuations. And the UK is right at the moment trading at this kind of broadly cheapest valuations relative to other global markets in about 30 years. And the reason for this is because global fund managers have essentially used Brexit as a useful excuse to put the UK into the too complicated to worry about pile. So they pulled their money out of it, and that leaves an opportunity for us as kind of local, more focused investors. So yeah, I think it's time to invest in the UK. I do take Jim's point about payout ratios. There's a couple things I would say about that. One is that means you just have to be a bit picky about the kind of individual stocks that you buy. Also, I would point out that the dividend payout ratio has been kind of ringing an alarm bell for certainly a good 3 or 4 or 5 years now. And clearly that still hasn't panned out. So it's just worth remembering that it's good to kind of consider these things, but it's also very hard to time when there might be the income crunch that we're kind of told about. I'll just pop on to the next slide. So one area that I've been looking at in particular that I think is kind of interesting from an income point of view is the real estate investment trust sector in the UK. For a start, it's kind of UK focused. So you are talking about, one reason why dividends are so high on the FTSE 100 is because a lot of them are paid out in dollars, and so you've got the impact of currency exchange there. That's not an issue for the real estate investment trusts. The other thing is that sentiment towards that market, I feel, is incredibly negative. Every other day, and it's not just about Brexit. It's like the headlines like the high street is doomed. Interest rates can only go up, which I entirely agree with, but that's been the case for years and years now, and at the moment it looks as though if they do go up, it's going to be on a very slow basis because we've seen central banks around the world change their minds and kind of U-turn. And obviously we've also had the idea that Brexit will mean mass exodus from London property in particular. Maybe that's true, hasn't happened yet. Okay, so again, don't mind whether you voted leave or remain, but the fact is that we haven't had this kind of mass exodus. So I tend to think that maybe now, if you are looking for stuff to put in pot 3, kind of individual stocks or stuff that's a bit riskier, then you should investigate the real estate investment trust sector. Now I'm going to highlight a couple of names here because I know that given this audience, you are all looking for interesting stocks. What I would also say is, go away, do your own research, see how it fits into your portfolio. But on that basis, a couple that I think are worth looking at, there's New River REIT, which is a real estate investment trust that invests in essentially local shopping centres. So it's not the kind of thing that's kind of going to get hit by the kind of macro stuff. It's places where you might have a co-op, you might have even pound shops, that kind of thing. So it's the kind of thing that's a bit more durable to a downturn. They've got kind of occupancy rates of over 90%, actually over 95%. So extremely high occupancy rate. They've taken a tiny bit of a knock on rents from some of the turmoil on the high street, but they've been able to get new people in to cover it. It's not overly stretched leverage-wise, and the current dividend yield is in the region of about 8%. Now, as Charlotte, I think, would point out, you shouldn't just look at dividend yields, you shouldn't just look at income. Total return is crucial to all this stuff. But from our point of view, the dividend looks sustainable. It's come down a lot since its high in 2017, so that looks like a good one to me. If you're more interested in something that's a bit bigger, British Land is another interesting looking play. British Land is a big owner of offices in London. It's kind of, again, been knocked down. It trades at a discount to its net asset value of about 35%. And you're looking at a dividend yield there, which isn't as punchy, but it also has a share buyback program, which I would suspect would carry on, which is yielding about 5% just now. So that's why I think the retail investment trust sector is worth looking at. And there are lots of other kind of fascinating stocks in the kind of UK market at the moment. If you go down a list of the all share, then you will find some very attractive yields there. Now, as I say, it's important to look at dividend cover, but a lot of these stocks have been sold down because they're in the UK and nothing more than that. Now, the other point I would make, Lo, and this is where I'm going to hand back to Charlotte, if you're worried about income, if you're worried about returns, that's all the kind of headline stuff. That's the interesting kind of, for want of a better word, slightly sexy stuff. But there's no point on getting a 8%, 7% dividend yield in at one end if you're paying out kind of like 2% on costs and trading costs at the other end. And I think that's why fees are crucial, because dividends are unpredictable. They're not as volatile as share prices, but they are obviously unpredictable. They can be cut. The one thing you can control is your cost of investing. And so, I think I would ask Charlotte, actually, how does that play into the way that you guys manage your portfolios?
Yeah, thank you, John. This is something that we're absolutely laser focused on, because it is extraordinary how much of your capital can be eroded if you are overpaying in fees. As a rule of thumb, if you're paying 1% per annum more in fees than you need to, the cost over 10 years will amount to between 14 and 15% of your capital. So for every £100,000, that's giving away 14, 15,000. Add another naught on that if you're thinking of £1 million, that's £150,000 that you're giving away to a wealth manager, potentially unnecessarily. So when we think about investing, and as you're hearing from Jim and John in the round, then cost and transparency and liquidity is part of what we believe will allow us to create the best all-round returns. And we believe that one of the best ways to do that is to make that core pot, that pot 2, have it populated with passive investments. So what I've put up in front of you here is some Morningstar data where we've taken the most generic sectors from Morningstar. So you can see we've got the UK all companies, UK equity income, US equity, and so on. And what you can see is over the last 3 years, and by the way, this looks pretty similar for over the last 5 years, you can see that active managers, and again, this is an average across the sector, and we all know that there will be individual managers that do outperform and have outperformed, but on average, the active sector has underperformed. And by the way, they've underperformed by significantly more than the excess that you pay them in fees. So it's not just because you're paying them high fees. There is actual, real underperformance in addition to that. So you can see they've underperformed on average by around 1.5%. Now, the other interesting thing to me about that is you would have expected that maybe it's hard to outperform in the most liquid markets, so US equities, for example. But what you can see here is in less liquid, less efficient markets like emerging markets, there's a significant underperformance by active managers as well. So going back to that sleep well money, the core pot that is surrounded by those much more interesting satellite investment ideas that John just mentioned, this is where passive starts to come into its own. And it's where we can really start to build an investment that is going to allow us to keep costs down and keep our efficiency levels up. And I think one of the things here that you'll see is I've also put down UK equity income, because where there are fads about managers, there are often as well fads about investing style. And probably income funds have been one of the single biggest fads that we've seen over the last sort of 5 to 8 years. And no surprise, because of course it's incredibly hard to generate income. We're earning nothing on our current accounts. We're earning very little in deposits. You know, yields are low, credit spreads are low. So what are we meant to do? An income fund sounds good because it talks about income. I am, and I know John is, and I believe as well Jim is, a big believer in total return. So this idea that you can generate returns from, it doesn't matter whether it's income or capital gains, it's the overall return that matters. And then, and this is where a group like Netwealth really specializes. It's actually down to modern technology that you can curate the type of income stream that you want. So there's nothing that says you have to buy an income fund to generate income. You can have a portfolio that generates income in the round through total return, and then, as I said, have those custom cash flows curated for what you need them for. So whether it's educating children or paying for care home fees or some sort of ongoing outstanding cash flows that are specific to you. And this is where we see our clients reacting incredibly positively, because of course we all as individuals have different needs, different goals, different requirements over time. And as we've seen earlier, that time could extend for a long period. And maybe just to go back to that notion of time and back to that notion of cost, if you were, for example, 65 today and you were just starting on taking your pension and you had 650,000 invested in that pension, you could take £25,000 a year till you're 93. If you were to pay just over 1% less per annum to have that pension managed, the income from it would go up 15%. So you would start to be able to create those, better cash flows, improved cash flows that will last you, in this particular example, until you're 93, which, as we've seen, may not be quite long enough. So that's the other thing to think about is, how to create those all-in total returns for as long as we can in as efficient way as possible.
So Charlotte, if I could ask you, your total return fund, the Pot 2, the Sleep Well at Night fund, has a fee, if I remember rightly, of 0.35% per annum. Is that correct?
From 500,000 up, yes.
Right, which is incredibly good value for money. And at all lower levels as well, it's much, much cheaper than... I remember when I was a young guy, I started a fund management company. We were charging 2% and 20% performance fees. And we could do that because we were in obscure emerging markets. And also, return volatility was very high. So, in some years you could be up 50%. That doesn't happen anymore because we're in this low return world. So first of all, on a fee level, Netwealth is incredibly good value for money. What would your typical portfolio consist of? If I wanted to drill down into what your Pot 2 had in it, what sort of investments do you make that provides a superior return at a lower cost to investors?
That's actually a great question, because we have 7 different risk levels, from risk level 1 up to 7. Risk level 1 being the least risky, and that is typically has very little equity in it. It has some floating rate notes, some index-linked government bonds, some cash, and it's simply designed to give you a return of 0.5% over inflation. So very important. It's not trying to be cash. It's trying to make sure that at worst it delivers you inflation, and therefore your money doesn't get eroded by inflation over time. If we were to go up to risk level 7, it's 90% equities, but these are globally diversified portfolios. So it'll hold some UK, it'll hold US, emerging markets, Europe, and Asia. And then it will have the 10% in fixed income will be in the higher yielding area of emerging market bonds, for example. But what's interesting about that is our risk level 7, while it's our highest risk level, it's probably low risk compared to things that sit in Pot 3 and the things that you monitor and enjoy investing in every day. So they're very complementary to each other. And in terms of returns, going back to Jim's point about fees, our net returns, so net of all costs, have outperformed the peer group across any given period that we look at, across the 7 risk levels. And that is largely down to the fact we are much lower cost. And it's then also down to the fact that you have a group of experienced investors who are focusing on investing via passives, but have active asset allocation that they use, so that you have a team of people thinking about what that mix should be across the different global markets that we were just describing, to make sure that it's the optimum mix for those different 7 risk levels that I mentioned.
Thank you very much, Charlotte. So John, turning to you, at one point in the recent past, BP was the biggest provider of dividends to pension funds and institutions in the UK, and indeed to retail investors. And then the Deepwater Horizon blow-up occurred and BP's dividends were suspended for a number of years. Now it's back to being a 5.5% or 6% dividend yielder, and actually is one of the stocks that I quite like myself.
Yep.
How do investors avoid BPs? How do they also look for red flags when, for instance, Into, which is the big, you talked about real estate investment trust, Into is the biggest owner of retail parks in the UK. And actually, it's a company that I quite like the look of at the moment. But how do the individual investors avoid the BP disaster, or is there just nothing you can do about it, or the Into, where the dividend yield was, I think, 12% at one point, and then they cut the dividend? Can you give us some pointers as to what we as investors should be looking for?
Yeah, one answer is really boring, and it's the one that everybody knows and nobody wants to hear, but it is diversify. If you're going to build a portfolio of high-yielding stocks, then, I've got a chap I used to work with, who a lot of you will be familiar with, called Stephen Bland. And the way that he builds high-yield portfolios is by taking one big stock from each sector. So you'd have BP or Shell in the oil sector, you'd have Glaxo or Astra in the kind of drugs sector, you'd have a bank, all the rest of it. And so by doing that, you get diversification across sectors, and by sticking to certainly kind of larger stocks, you tend to be shielded against the balance sheet risk to an extent. Because the problem is, something like BP, you can't plan for that. That is an operational risk of oil companies. Nobody could have seen it coming. And so you just have to accept that this kind of thing's going to happen. So to get rid of that risk, you have to diversify. Same with something like Patisserie Valerie. In hindsight, if you really forensically examined the accounts, which nobody did, because I don't remember anyone seeing that one coming. You could have told in advance, but most people didn't. So that kind of blow up, you just need to diversify to get away from that. As far as warning signs go, the market does give you a warning sign of a potentially unsustainable yield, which is it's yielding 12%.
Yes.
It's like, okay, it's yielding 12%. Well, that suggests that no one thinks it's going to pay that out. And you can definitely see quite a few stocks in the market at the moment that are, have yields either at those kind of levels, which are just clearly unsustainable. So one thing I would, sometimes they surprise us, but if you see a yield that is massively above its sector average and massively above the market average, then you should just do a lot more research into it and make sure that if you buy it, then there's a reason why you think you're right and the market is wrong. Because it's clearly signaling that the market does not believe this dividend is sustainable. I think quite a good example, big example at the moment is Vodafone. Vodafone, certainly up until recently was yielding something like 9%. And the chief executive, etc., is saying, oh, this is a sustainable dividend. The market clearly is skeptical on that. Now, whether the market's right or not is a thing that you have to decide for yourself. As I say, do your research. If you think you know better, go for it. But yeah, that's it. I think that, to be honest, I think that's probably the most obvious red flag, is just that the yield is so high.
Yeah. That's very interesting. Just as an observation before I move back to Charlotte for a final question, because we're running out of time here. It's interesting that the banks give you nothing on deposit now. You might get 0.5% if you're very lucky and very wealthy. But the bank shares are yielding quite well. I think Lloyd's at 6%, HSBC's not far off. And to me, the banks in the UK are actually pretty good shape. They've recapitalized, they've paid their fines, which I'm going to show in my talk later on are absolutely enormous. And that might not be a bad strategy. What do you think about that?
Oh, definitely. I like the banks at the moment, if I'm honest. I think the other interesting thing about the banks is after the tech bust, it took the tech stocks something in the region of about 8 or 9 years to bottom out. And in fact, it wasn't until after the financial crisis that they sort of hit rock bottom. And a part of me wonders if the financial sector is undergoing the same process just now, particularly the banks. The banks were at the epicenter of the last big crash. And so people are still, if you like, psychologically scarred by that and avoiding them. But I can see that the financials may be where another big contrarian opportunity is at the moment. So yeah, I think you're absolutely right.
Thanks, John. So we've just come into a liquidity event in our own business, and I'm going to actually give Charlotte's company some money of mine to manage, because watching the markets all day long and all night long is not for me, and someone with a professional team such as ourselves makes a lot of sense. But what I want to ask you, Charlotte, is you have a different model to pure FinTech or pure fund management, because people can come and see you and talk about their own requirements, but you're using automation to cut the costs and to improve the efficiency. Is that correct?
Yes, I mean, the way we think about it, so you use the word FinTech, and whenever anyone asks me about FinTech, I always say we're more fin than tech, because first and foremost, we lead with wealth management and asset management experience, but of course, we've been able to build our own proprietary technology. So we have our offices in Charlotte Street, which is Tottenham Court Road, and Oxford Street, right around there. We have a lot of clients who come in to see us, and then we have others who talk to us via Skype or other means. And really what we're trying to do is totally change the way we interact as individuals with our wealth. So we want to make this a more personal, a more accessible, a more user-friendly experience. And one way that we can do that is that technology starts to make things more easy to understand, so that if we're thinking about personal goals and we want to figure out, do we have enough in our retirement? Or what happens if I do live an extra 10 years? Or is my income requirement of 7% per annum realistic, and how much money would I need to support that? All of those things can be modeled. And what we're finding is that, so our typical client, for example, would be somewhere between 40 to 65 years old, often professional people who are time poor. They're busy doing the bits they enjoy in pot 3, and they want somebody else to sort of do some of the heavy lifting, as you said. They don't want to spend day in, day out managing their own money. So it's a very nice complement to what they would naturally want to do.
Thank you. So Charlotte's Netwealth stand is somewhere behind this wall at the back here. I urge people to go and visit it. It's a very good complement to the Fidelity stand, and I think that they work very well in terms of constructing personal portfolios for people. John's book is available, I assume, at all good bookstores and on theevilamazon.com. So with those two takeaways, I'd like to thank both the panelists today for coming, and thank you, ladies and gentlemen, for attending. So thank you very much.
Thank you.